That's what she said. Tomas, we are back, my friend. You know what that means? Time for a little option jive.
Are there different types of neutrality? I think there are. I could name a few, but
I don't know. What's your definition of neutrality?
different ways to get neutral on a trade.
Sure. Yeah. Less risk, more risk.
So one of the benefits of option trading is the ability to be directionally neutral on trades. Directionally neutral. All right, I'll give that to you, counselor.
It's neutral is a direction. We've said it on this network, for sure.
However, directionally neutral can be defined in several different ways. What's the difference between each definition of directionally neutral, and when should each be used? Let's look at some examples. Do you know off the top of your head, what do you do when you're looking at it? Let's say you're doing a strangle. Mm-hmm. How do you do it?
I'm typically somewhere around the 20-ish delta on both sides.
So you go to 20-ish delta.
I do, and then I'll look at skew. Like, if I go to the 20-ish delta and one option is $2 and the other option is like $1.25, I will move one side a little bit closer to get around the same amount of premium on both sides. I will also look at skew and maybe do a ratio spread if so inclined.
So,
to that
like,
direction.
for example, this morning, I adjusted natural gas is down pretty big this morning. Mm-hmm. And so I needed to adjust my natural gas strangle. So what I did is I just look at price. It's like on one side, let's say I'm short a 12-cent put, and the other side, because it's going down, I'm short a 4-cent call. I'll roll my call from 4 cents to 12 cents.
Sure.
To
And that's
neutralize it.
That's $1,200 and $40 when you
Right.
$400 you're talking about.
So sometimes I'll use price to neutralize. You know, this morning I rolled down in soybeans. Soybeans are up big today. So my call was like, let's say 7 cents and my put was 15. I'm sorry. My put was 7 cents and my call was 15 cents. So I rolled my put up to 15 cents because the soybeans are higher. Mm-hmm. And in natural gas, I did. So sometimes I roll just based on price. It's simple, easy to do, blah, blah, blah.
Yep.
So that's one way of adjusting based on price. Another way is when I'm opening a trade, I will look to do, like you said, 20 delta on both sides. Mm-hmm. Mm-hmm. And sometimes I'll just say, I'm just going to go 10 points around. Right? Let's see what they did.
So it varies for you.
So it varies for me. Okay. Yep. So what's the difference between each definition and when should each one be used? Let's take a look. It's subjective, but let's take a look because we've never really done this before. So delta neutral strangles have a put and call deltas that are equally far from the at the money. Delta is the theoretical change in an options price given a $1 move in the underlying. For contracts with deltas between 10 and 30, delta can be used as a proxy for the probability of that contract going in the money. This strategy gives a trade where there's an equal probability of the underlying reaching either strike based on the option pricing models. Like the reason we use 20 delta is because there's an 80% chance it don't get there.
Sure.
Let's go to the next slide.
You're doing one side.
So the first thing we're going to look at is a delta neutral strategy. So like what we did here is we looked at, it's too much to scroll through it. So we're just showing in this case, the call side, but you can see where we circled the total delta on this position. This is a one lot short strangle in the SPY, and the total delta is less than 1 share.
That's correct.
It's like 0.79. And we went, in this case, to the 16 delta put and the 16 delta call.
Yeah, that's as delta neutral as you're going to get.
Yep. And that's using delta to create delta neutrality. Mm-hmm. Okay, let's go to the next slide. But sometimes, like I talked about a few minutes ago, we'll go to doing things price neutral. Price neutral strangles consist of a put and call that are approximately the same price. This strategy gives a trade where there's an equal expectation of tail risk to the upside and the downside of the underlying in the short term. Like I mentioned this morning in natural gas and in soybeans this morning, I used price to neutralize my strangles. What I tend to do is open based on delta and use price based to do simple adjustments. Let's go to the next slide. And as you can see here, there is slightly more delta. When you use price, you are going to have slightly more delta because there's going to be skew involved, especially in something like the SPY.
Sure. So if you go back and look at what that delta is on this one, it's almost 4.83.
Yeah. So the first one using 16 delta options on both sides, the delta was under 1. When you use price, you're gonna sell in this case, you're selling like a $3 put and a $3 call, or almost $3.50 on each side, but you're not going to be exactly delta neutral. You're going to be a little bit different. I'm totally fine with this, by the way.
Yeah, sure.
Totally fine.
Sure.
Let's go to the next slide.
Even better if you're slightly bullish too, right?
This one is something that a lot of traders use. They go equidistant. Equidistant strangles have put and call strikes that are an equal dollar amount from the current price underlying. Like somebody will go, well, something's trading at, and people tend to do this more for like iron condors and stuff for the short strike, but they'll go, oh, something's trading at 100. Well, I'll sell the 90 puts and the 110 calls. Like it's harder in the SPY because it's almost $500. But if you're talking about like a $100 stock, you go, oh, I'm just going to sell the 90 puts and the 110 calls. That's equidistant strangles. This strategy gives a neutral trade based on the assumption there's a 50-50 chance of an up day or down day. And the magnitude of the moves will approximately be the same. Sure. Do we do this? Of course we do. We do all three of these, is my point. We do the delta neutral trade, choosing it by delta. We do the price trade, which we do all day long. And then we also do equidistant strangles. More equidistant for opening, or for recentering too. Like we'll recenter all the time based on equal distance. Let's go to the next slide. And you can see here's an equal distance strangle. And you can see there's a tiny little bit of delta, tiny little bit. But all three of those ways are different types of delta neutrality and different types of strangles to create delta neutrality, either using delta itself, either using price, or either using equidistance. And you can always tweak these.
All of them are acceptable, right?
All of them are acceptable.
Sure.
All of them are fine. All of them are legit ways to do it.
Right. And if you look at the probability of success, depending on what you want to be, that's how you might decide to choose which one you want and the delta.
Let's take a look at the next slide. All these definitions of neutral are founded on the assumptions around future underlying price moves that may or may not be true. However, since each of these neutral strategies have different risk-return profiles, it's generally good practice to include several types of neutral trades in order to achieve diversification. I agree with that. And like I said, we use all three of these, and we use all three of these almost every single day. When we recenter, we use equidistant. When we adjust, we use price. And when we open, we use delta. It's crazy. Let's go to the last slide. There are many definitions of neutral, and each one is defined with respect to one of the many different option variables. Choosing a mix of delta, price, and distance, neutral strategies can give you the most holistic portfolio diversification since each strategy has a different risk-return profile. And there is no way to fully eliminate all portfolio volatility, but employing different types of strategies can definitely help to reduce it. And like this segment says, Tony and I use all three of these methods almost every single day in almost all of our trades.
Yeah. Let's take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell, Sosnoff. We'll be back in 90 seconds.